Okay, welcome to day 4, part 4 of the Market Makers Method. I hope you are doing well, and this video is going to find you well. I hope your trading is you are turning around the corner, and I'm making sure you've done your homework from the previous video, day 3, now day 4, which is probably the final day of me teaching you. And today we're going to put everything together. Okay, so everything should have started clicking back on day 2, maybe day 3. If it does not click after this day, then there is a major problem. You probably have to restart the videos or contact me, tell me that, hey, I'm not understanding what you're saying, it's Greek, I can only understand Spanish. Okay, yeah, let's get started. So the first thing for us is to understand the rules to profit. Okay, so you need to stop trading every day. I'm not saying that you should not come to your workplace or your office every day, be there, show up every day, but when you don't have a trading setup, you don't have a trade. Okay, the other thing that you need to do is to learn to become highly selective. Be a sniper, don't take crap. Okay, don't trade garbage. This is where you make a mistake. I know you just think it's a stop and hey, 1 2 3 I'll sell. Hey, why can't you wait for the second leg of the M formation with the railroad track closing below the 13 EMA and the TDI is diverging, everything in the same place? Okay, so you have to set your hours as follows. You trade the first 4 hours of the London session, you take a break, and then probably come back for the first 2 hours to 4 hours of the US session. You can trade the Asian session, but for me, it's not quite profitable. There are less is available during that time. So the other thing is that you have to learn to capture 50 pips, not one more. So once you end a trade, I would like you to set your take profit at 50 pips, especially if your stop loss is less than 20. That will give you 1:2. It's enough, 1:2. Don't try to make 100 pips, 1,000. Greedy kills all good traders, trust me. Back then when I was trading in smaller accounts, I had a trade that I ended on the Swiss. I don't know if it was Euro CHF or USD CHF, where I was trading with 0.01. Okay, and I had a profit of $10. That was about 100 pips, and I increased my take profit to $25. Think what happened at the end of the week. I lost the trade. I ended up being in -2. It's all because of greed, guys. So the objective of trading is time, freedom, and leverage. Understand that when you are trading, you want to have more time, you want to spend less time on the screen, you have freedom, and make a lot of money of that short time. So if you only manage to catch these 50 pips, you might say, hey, what could 50 pips do for me? 50 pips is peanuts. I won't be able to do anything. 50 pips will not be able to make me buy a car that I want. What you need to do is to first master making 50 pips. Once you master making 50 pips, then you can ramp up your account and then add contracts. This is where you will see other guys taking a risk of 10%, 20% of their accounts. It's because they are confident. They don't take crap and they take target only 15 pips. The last 50 pips, sorry, 15 is peanuts. The last thing is for you to take only the crystal clear setup, whatever that means for you. For me, it's consolidation vector 1 2 3 and a W formation. That's clear. Okay, this is a clear setup, especially if it's a type 1. I think I told you on those types. For you beginners who are starting in this method, I only want you to trade type 1. these are the most easiest to identify on the chart. Okay, so the other one is that understand that the market maker patterns outweighs all man-made indicators. I don't want someone to ask me, hey, the 5 and the 13 have crossed, shall I buy? No, you can't buy after the 5 and 13 crossed. You should have been in from the low of the day at the railroad track or close above the 13 EMA. Once those moving averages and what don't use the indicators to enter, just use them as confirmation. So in order for us to understand how to read the charts and identify the market makers in changes, some indicators were applied to the chart and will help you to understand the timings, the entries, and the exits. So since most of us have fallen victims to popular technicals and we have used to them, like me, I understood them fast. The transition will be fast, especially if you've traded. If you've traded, you will be able to know that the RSI, what is an RSI, what is a moving average, what is a pivot point, everything. Okay, so the other reason for you why 50 pips, the reason for you to take 50 pips is because you will not deal from the absolute bottom. So if the pay is an average of 75, you deal from 10 to 15, you add that 10 to 50, you now it is kissed the ADR is 75. You don't have to take the 100% of the 100% of the ADR because you don't know if it's going to reach it. Okay, so just target 50 pips, guys. Okay, I hope this is simple. I'll see someone will cry because of this, because he or she did not listen. I will tell you. You must include the spread and the slippage, okay, of the average pen. Going to open your broker spread table to know what the spread variations, what their slippage, which is the cost of doing business. Okay, so you also have to understand that all three levels do not present every day, so you might only get one or two levels. Okay, so if you get one or two levels, you should be able to book profit, not carry your trade to tomorrow, because he will re-evaluate his book, and then you will need to restart. And then if he thinks that there's someone or there's a lot of money sitting at your position and he comes back when you were up 52 pips, 54, and you did not take that off the table, you leave your trade, you end up with minus 11. That's a crime in any country you live. Okay, don't do it. So level 1 and level 2 will average about 75 from the peak formation, high or low, to consolidation on end of day. This is why you need to deal with 50 pips. And also, for you to profit, you must have a reason for entering the market. The reason will be based on level counts, the directional bias, the setup type that is being presented. Then you buy. You only have two conditions to buy: after an upward stop and M formation, sell after an upward stop and, this is what I mean, upward stop and M formation, or buy after a downward stop and W formation. This is what I mean. Or you have to stay out. I think staying out of a trade sometimes it's a good trade because you won't lose. Trust me, I've lost money because I feel like today I need to be in the market. The things are not moving. Let me jump in and try to grab something the market that will make pay. The market maker will kill you. Okay, so the rules to profit, you also need to have a trend evaluation and count how to check down what to trade, the best times to trade, which I gave you: first 4 hours of London, first 4 hours of US session, and then you have to manage your trade while it's on. Okay, so how do you look for an end? Guys, look at this slide. My slides are messed up, I'm sorry. For the part 4 of this video, we are going to look at how to look for an end rules, trade management, EMAs, TDI, yesterday's tracer, and some pivot points. Okay, so how to look for an entry? Okay, to look for an entry, you have to identify the market maker cycle to determine your directional bias on the 1 hour chart, marking up your levels. Then you drop down to the 15 minutes time frame to find the pattern, type 1, type 2, type 3 to enter. Okay, identify the entry triggers, the confirmations, candlestick patterns, EMAs, the TDI, the confirmations, they will come. Okay, then after you enter, you have to manage your trade using a stop loss and TP. You have to know when to get out early if needed. Okay, so as soon as you enter, set your stop loss and take profit. Please do not use Mendel stop loss. Okay, a Mendel stop loss is where you just buy and you don't put a stop loss. You say I'll exit at 64.40 when it reaches that level. When the dealer reaches that level and you're at minus $100, a lot of us will not close or move our stop loss a little bit down, and you are to minus 500, 150, which will end up in a blown account. This is what will happen. Okay, so what to look for? You have to look for a super clear market maker cycle, and you look for a super clear London pattern. Okay, looking at this thing, we had our peak formation here, level 1, level 2, level 3. Okay, in here after level 3 price drops. This is day 1. Okay, I'm now trading away from the peak. Okay, so what am I looking for now? I'm looking for a type 1 London pattern, consolidation, stop and aim formation, price will drop. So you have to look for this thing in here. This is the pattern you are looking. This is called a safety trade. Okay, away from the peak, it's a safety trade. That's the safest trade you can take in any market, in away from peak trade, because the dealer is trapped people off the high, and now he is shifting the zone. Okay, so you should also be able to project and anticipate what is going to happen. So you have to identify where you are in the count, and it will help you to project the next move. So like here, I've identified that now I'm probably in level 1 of the peak in here, especially if this move was 1 times ATR. Okay, I'm now going to project and anticipate where the next move is. Okay, so the peak formation must always be identified and trade away from the peak. If a double peak formation appears on a higher time frame, lights out, guys. Okay, so you see that you have an M formation like this over 3 days on a 1 hour time frame. That's a solid trade, especially if this move is a 1 times ADR. This consolidation in here will offer you a good trade if he gives a stop and to the high. Okay, so be able to anticipate that. Anticipate the directional move lines up with the peak formation, begins after a stop and the slow steady move, which will be the trend which you anticipate to enter the trade, should last for 6 to 8 hours or 50 pips. Guys, 50, 50, don't go more than that, you'll kill yourself. If level 1 is identified, the trade will offer more pips and can be converted into a swing trade. I did another video on swing trading. It's a separate video, but what it simply means is that from peak formation in here, okay, we're in level 1 now. Okay, we have a stop and you buy in here, you hold for level 2 into level 3, so you hold, you won't exit in this. But this is now contradicting with the 50 pip rule. That's why I gave you. I have to teach everything to you. You have to select yourself. Everything is down to personal matters. I do both. I do swing trades and I do some spot trades, and I'm good at both. Okay, so looking at here, okay, back on this slide, what am I anticipating? I want to say 50 pip Asian box. Okay, today I have 55. Okay, I want my stop one to come to the 25 pip pre-measured box. It happens to have an 200 EMA, so I expect my M to be formed at this high. As soon as the M is formed and confirmed, I enter the trade. It's a sell. Okay, 50 pips, I'm out. The same for the next. Where is I didn't put it. Okay. For the types of trades that I told you, spot trades are. I'm a fan of spot trades. I enter and exit on the same day doing day trading, although I do swing trading where I hold the trades and they offer me more pips, and I will set my take profit usually 3 times ADR. So if I'm a swing trader, I enter at this low, I will have to wait for what? 3 levels of rise, then I take what? And exit. This is what is yes to happen. So for our trade management, our goal is to get something between 30 to 50 pips. It will depend on the ADR. If the ADR is 48 pips, why putting your take profit 50? Is not going to reach the number. I hope you understand the numbers. So put your stop loss to be less than 10 pips, 10, 15, 20, 25 maximum, 23 maximum, I think. You consider the spread, okay, and you will not also deal from the high. Make sure you always get the risk reward to be at least 1:2 or better. For me, I'm at always 1:3. I don't go below that. For 1:2, those will be New York reversal trades, not London patterns. For me to do how to do analysis, okay, the right technical analysis gives the trader an amazing edge. So if you know to analyze your things well, you have a greater advantage. Guessing afford you a 50-50 chance where you are just guessing the side of the coin, where is it going to be a head or a tail. There are only two options, 50-50. Okay, so I'm telling you, we are not in the 50-50 business. If you want 50-50 business, go and play gambling. You can go to the nearest casino, you bet shops, some illegal gamblers. Okay, so by mastering the market maker pattern, you can reach your trading goals because you are analyzing the real market and you know the real market conditions and you know how does the real market behaves and what does it look like. Okay, so for you, when you are doing your analysis always start on the 1 hour. Okay, you have to consider also the H4 for what? For the weekly cycle. You have to consider what level are you in? Are you in peak formation? If you are in peak formation, you are going this way. Okay, where is it going? Are you expecting the W, the VV, the M pattern? Okay, what day of the week is it? Is it Friday? Okay, if it's Friday, there is always a false move week ending. Okay, so expect him to go back inside the range on Friday. Okay, this will depend, and you will see it what I'm telling you on days and etc. What has happened on the last 3 to 5 days? On the last 3 to 5 days, I had 3 levels of rise matching 3 times ADR. I am at peak formation. I expect a reversal. Is a straight away possible? Are you in level 1 and you are trying to counter trend level 1, DNC level 1? Do not counter trend level 1. I told you it's a circus play. You are trading back into the peak, you will lose money. Okay, so you have to form your directional bias based on the H1 chart, which is the weekly cycle, and you can see the levels. So just try to get an idea of the overall direction, the trend, the real market maker trend from the peak formation. It will always drop 3 levels. Counter trend will only be done at level 3, where you trade both ways, where we do range trading. Only level 3. Level 3 you can buy and sell as long as you're in level 3. You have something like 1, 2, 3. Okay, so if he's in level 3 and he does this top and high, you buy. The next morning, if he's still in level 3, he does this, you sell. He comes back, you buy. This is where you do range trading. But always understand that sometimes level 1 can be formed inside level 3. You get smoked if you try to do range trading there. So I told you, always take high probability trades in line with the trend. So try to sell peak formations high, buy peak formations low. Don't sell a peak formation low or buy a peak formation high. Okay, so you have to ask, what level am I in? Is a counter trend level, sorry, what level am I in? Okay, if I'm in level 1, I'm not looking. If I'm in level 1 like this, I'm not looking to buy. My only way is to sell. So I'm waiting for a stop and M formation. Is the reversal possible? Are you at level 3 and you're expecting something like this? So your job is to react to what the market maker does. You react to his actions. If a solid bias projecting and anticipate his next move, trade both directions without fear. The market maker trades in both directions. Why are you afraid to trade in both directions? Don't be afraid, but don't be stupid. Okay? I'm sorry guys, don't be stupid trying to sell back into the peak or buying back into the peak. That's being stupid. That's the worst crime you can commit. Okay, so after being done with our 1 hour chart, we know that I'm in level 1, I'm looking to go short. Okay, I'm in level 1, I'm looking to sell something like this. I'm now here, I'm anticipating what? A sell. I quickly move down to the 15 minutes time frame. I leave the 1 hour alone, leave it. I'm done with the 1 hour now. I shift to 15 minutes. So what I will do on the 15 minutes, then I'll scan for the proper channel size, which should be less than 50 pips, typical. Okay, I will look for the breakout move, the 3 swipes, the false move, the stop and in 1, 2, 3. Wait for the high of the day to settle, consolidate. Okay, the market maker will hold the high for what? 30 to 90 minutes, forming in M formation. I'll get sometimes an RRT on the second leg. That will be good. Okay, and I want to see if we come to retest the high. I'll place my order with my stop loss, take profit. For you, if you want to place a trailing stop loss and you maybe sell and you think you don't want to set a TP, use a trailing stop loss of 32 pips. Okay, so some end rules. Second leg M or W at or near the high of the day. Okay, so you have to see what candlesticks are they showing. Is it an RRT? Do we have a code of wood? Do we have an evening star? Did we get a close below or above the 13 EMA? So sure, if I have an AM in here, I expect the M to close below the 13. If it's a W, expect it to close below the above, sorry, the 13. This is a 13 EMA. It will be red. Okay, so I also have to confirm with the TDI, the RSI line being above the signal line, above the market baseline. Okay, so let's look at a typical example from last year. Most of the examples I'm showing you guys are the trades which I took. Exactly. On this Euro USD, I took 3 trades. In fact, I would say 4. Okay, the first one was here. This was my first trade, this was my second trade, and this was my third trade. The fourth trade was from here to here, which was a swing. trade. Okay, how was I able to do that? Let's start from here. Peak formation low. Okay, from a peak formation I expect 3 levels of rise over 3 days. 1, 2, 3. Okay, I am now in level 3. I also expect level 3 to hold for more for 3 days. 1, 2, 3. We are still in level 3. So if I am in level 3, what am I looking for in level 3? Consolidation, stop and up M formation, I sell. I come back to level 1. I am now in level 1. What am I looking for? I don't buy in here. DNC. I told you this. Don't go back to the peak trying to buy this. No, that will make you lose money. What you are looking for, it's a safety trade, the safest trade you can ever enter. Consolidation, stop and M formation, pulls off. Okay, then the same here. I'm in level 2. Consolidation, stop and M formation. So let's look at the first one here, which led me to enter the swing trade and the spot trade on the first day. Okay, can you see the clear super market maker pattern in here? Asian range 6 pips, 6.7, stop and 1, 2, 3. The first move to the high of the day, repeats the high of the day. He came above the high of the day in this candle, induced more people to go short, to go long, sorry, to buy this pen, and he gave me an evening star which closed below the 13 EMA. This was my sell. I entered immediately. I did not put my take profit above here, my stop loss, sorry. I put it above this candle for me to gain more on risk to reward. Okay, because I knew if it was a solid London pattern, the dealer would not come above this high. There is trapped volume in this pin. He will not come back, especially if he closes above or below the 13 EMA. This was the first trade, London type 1. The second trade was an M formation safety trade of the mayonnaise. As you can see, I had price pumping off from this consolidation. This is tight consolidation. Although we have a smaller range, we have our first leg coming, pulls back. The second leg comes above the first leg. This move cleared the stops of everyone trying to sell on this move, and it induced more people to buy. Okay, so more people buy. This candle was solid green at some point. As soon as this candle closed, I was afraid to enter. Truly speaking, I could have entered, but I did not. I waited for the next candle. I entered, placed my stop loss. I grabbed my 50 pips. This was now the next day after that trade that I showed you. The next day, I think you can see this is what we call a type 2 London pattern. Consolidation, false move, stop and close below the 13 EMA. I'm a seller in here. Stop loss goes above the high. I put my take profit 1:3. If my stop loss is 10, I will go for 30 pips. So this was the cycle. Going the other way of the low in here, this is where we ended up being. We have level 1, level 2, we have a W, and the market comes aggressively, inducing more people to sell, immediately pulls off. This is now a safety trade. This is a safe trade to take. It's an away from peak. I'm not trading into this peak. I'm going away from the peak in line with the market maker. It shifts into level 2, level 3. This was a type 1 London pattern. You buy, you have a New York reversal at the high, you sell. Okay, I hope the things had been clear. So this is how you put together your H1 and your M15 together for you to enter a trade. Okay, let's jump to some indicators. The exponential moving average, TDI, pivot points, the tracer. Okay, so exponential moving average. The exponential moving average, they give us a true reading of market direction. Okay, so whenever a smaller moving average is above a bigger one, okay, so suppose this is a 50 and this is a 200, this is said to be an uptrend. The opposite is true for a downtrend. Okay, so for a true reading market direction of market momentum, offer true reading of market direction. Okay, they also offer reliable entry and exit signals. So if price consolidates in here and my M formation is formed at the white line, the 200 EMA, that's a solid area, especially if I have 25 to 50 pips in here. Okay, they will also allow me to exit if I have another moving average, probably the 800. I know that this is my exit. It will allow me to trade back into the range. So this is how you can use the moving average. They offer dynamic support and resistance. So for support, it has to be at the low. For resistance, it has to be at the high. Okay, they can also be used as TP, like I did on the previous example here where I saw the and used the TP in here to be at a moving average, probably the 800. Okay, so the exponential moving averages which we use, the reason why they are used basically is that they place weight on current price. So the average price exponentially considering recent data to be more important than the previous one. Okay, so the settings for this class will be 5, which is the mastered, 13. Okay, this is the mastered, 13 is the ketchup, we have the 50, it's called water, and we have the 200, which is the mayonnaise, and the blueberry, the 800. Okay, so crossovers offer solid trade signals when viewed in proper context of the market. Okay, like I showed you where we have the 13 and the 50, we enter in level 1. We now have a 50, 200, level 2, 50, 800, 200, 800, that's level 3. So the 5 and the 13, they are called the signal lines. Basically, when these lines are crosses, okay, the 5 will be, like I said, the 5 is yellow, like this. When it crosses the red line in here, you expect to go long. When it's going the other way, expect to go short. Okay, the 50 EMA is the balance line or the intraday trend. So if the price is trading below 50 EMA, it's said to be a downtrend. If price is trading above the 50 EMA, it's said to be an uptrend. Okay, the 200 is the home base. We'll use this for our take profit. Price will always come back home, it will always go back to the 200. The 800 is the major 4-hour trend. It's the 15-minute, the 800. Okay, it's the major 4-hour trend. I'm rushing myself. Wait for my slide to come and explain this thing for you. It's important to note that the 200 EMA represents the 50 EMA on the next higher time frame. Okay, so if I'm opening on the 15-minute chart and I'm looking at the 200 EMA, if I shift to the next 4 times higher time frame, 15 times 4, it's 50. Okay, This will lead me to divide 200 by 4 and get 50. Okay, I hope the math is simple. Just know that if you shift from 15 minutes to 1 hour, the 200 will be the 50. Okay, go and check that for yourself and see if I'm telling you something that exists. So why do we use these moving averages, the lines? The reasons is that the 50 and the 200s are used by most institutions. Like in one of the Wall Street books, where they use the market analysis, they use the moving average and the 50, the 200, and the stochastic. Okay, so when the 50 and 200 cross, they are used by the more books. Sorry, they are used by most people, and they appear in almost every textbook I have read. Okay, so you see that the market maker will trap of this moving average as people try to play those. For the 5 and the 13, they will match up with the TDI and it will give responsive signals with the TDI when you put them in context. Okay, then as you can see in red, like I said on day 1, okay, the market maker pattern outweighs everything. Okay, no indicator can replace your ability to identify the market maker pattern and the count that is to be done based on price candles. This will be used as confluence. Okay, no indicator will be used to identify the market maker pattern, and it cannot replace the pattern. Remember the most important things: the pattern, the timing, and fifth, a distant levels coming into the indicators. The indicators is crap. You might not need it. Some guys, they don't use them, but for beginners, I have to teach you how to use them. Okay, so understand that the greater the angle of separation in the moving average, the more likely you are in level 3 price action can be. So price can be ready to reverse. If you see that you are having a big gap between moving averages, like I showed before, I think it was yesterday, you are probably at level 3. Okay, so it is also useful to look at averages only. I want you to do this drill. Go and remove your price. Just look at the moving averages. You see that when they are widely open, you are probably at level 3. Okay, so since I will trade with 2 time frames, the 1 hour, the 15 minutes mainly, sometimes the 4 hour, it is helpful to understand that the 200 EMA on the 15 represent the current position of the 50 on the 1 hour chart. Okay, on the 1 hour chart again, the 200 on the 1 hour chart will represent the position of the 50 on the 4 hour chart. Go and test that for yourself. Try to shift around, mark the position of the 50 on the 4 hour, go down to the 1 hour to see if it's the 200. Okay, I hope that will make some sense. Okay, so once the relationship is understood, once you know that you're on a 15-minute price is close to the 200 or above the 200, there is no reason to go to the 1 hour to check if you are above or below the 50 EMA. I hope it's clear and you now know why do we look at this. Okay, so let's label our moving averages. Okay, our moving average, like I said, this is our mustard. Yellow is the 5. Okay, we have ketchup, red is 13. We go for 50, it is the color of water. This is water, and we have this blue line in here. Okay, it's the 800. Hey, is that a 0? is the 800, okay, and I left what, the 200, which is the white, the mayonnaise. The guys who named this, I think they named them off some restaurants, something you put on your burger. You have mustard, you have ketchup, you have water, you put mayonnaise, and sometimes you have some blueberries on the side. This is how they named these things, okay. The names doesn't matter, the numbers matter, okay. Like I told you, angle and separation between the moving average, there is a chance you are in level 3, okay. Peak formation, you get day 1, day 2, day 3. Now you go into what, in day 1, 2, 3, 4, 5, 6. This was day 7, okay. 7 days of drop. The levels are kind of hard to read in here, but the separation between the moving average, especially on this day, you could have seen that way at level 3, okay. So if you're at level 3, you are only looking to go long. Your only pattern will be consolidation, stop, and W formation. You go up. This is what you have to do. This is how this trade was caught on this day. This was USDJPY last week Thursday. I ended it. Most of the trade that I post here, I would have traded them, okay. So this is now GPP odd, okay. The separation between the moving average will probably tell me I am in level 3, especially I have some corresponding levels of consolidation. This took 1, 2, we have 3, 4, 5. On day 6 they rise, they freeze. Day 7 they create the high. On day 8 then price will roll off. Now it's at the 800. It will depend on what, are we in level 3, or we might need to reset the daily pattern or overweigh everything, okay. So next I have to move to yesterday's high low or marker, the blue dotted line, which I've been showing you since day 1. The reason why we have that is that this is an area of interest, since the dealer trap people and induce them to trade off the HOD and LOD. So he might repeat yesterday's high of the day and low of the day, okay. So if you see that your blue tracer is somewhere around here, okay. It's not blue, it's black. Your blue tracer is around here, okay, and you are having something like an M formation is about to form a second leg. I would advise you to wait for him to trigger this number and then come back, then he'll roll over something like this. It's more advisable. Sometimes you will miss it, but most of the times you trigger and induce people on that high of the day. The same thing will apply to the low, the W. Wait for him to trigger into the low of the day in here and then make a W, okay. So we have the blue tracer now on this chart. Tight consolidation, 10 pips, okay. Price will consolidate, price will break down 1, 2, 3 to make a W of the yesterday's low, or it might break high 1, 2, 3 to make an M of yesterday's high. This is why we have the blue trace. Expect an M formation to be formed at the high of the day. I hope it's simple, guys. It's just a line where you expect this M formation to be formed. So the other one is, which might be the second last, we have pivot points. Pivot points they help us to project the high and the low, where the high and the low will come in. They will act as intraday support and resistance, and they will give us a possible trading range, okay. So what we have on pivot points, we have 5 lines. each line will be labeled M1. Let me explain this. Okay, it's cool. It will be labeled M1. We have M2, M3, and M4. I want you to know that M1 will always work with what? M3. M2 will always work with what? M4. This is how these lines will work together. Okay, so if the dealer forms a high at M4, the low is at M2. If the low is formed at M2, the high is at M4. I think I repeated the same thing, but I just reversed. So what we use pivot points for, okay, is that price will just come in usually as what we had been doing since day one. It will consolidate off the central pivot points. Okay, this is the central pivot point. Consolidating on the central pivot point, price will make a false move to the downside going to the M2 pivot point. Okay, if he forms a low at the M2 like this, the high is going to be at M4 like this. Okay, if he comes back and consolidate in here and he thinks M2 is too close, I need to go to M1 probably, the low, the high will be formed at what? At M3, back at this pivot point. So understand that M1 works with M3 and M3 works with M1, M4 with M2. The same is opposite for the sell. Price will always open at the central pivot point. Vectors up 1, 2, 3 makes an M formation at the what? At M3 drops to what? To M1 to create a W to come back into consolidation. Okay, if it opens at central pivot points, decides to make the high at M4 in here. Okay, it will make a low at what? At M2. This is what pivot points are. They are just simply lines which will give you the average daily range. So for you to get the trading range of the day, probably if you subtract M3 minus M1, this is a potential ADR. M4 minus M2 is also a potential ADR. You don't have to draw pivot points, they are drawn for you on the chart. Okay, so the pivot points, they are calculated on daily candles. Yesterday's price action gives tomorrow's pivot points. A red candle indicates M1, M3 day, and a green candle indicates M2, M4 day. So if yesterday's candle was red, I know that today I'm going for M1, M3. I don't look at M2, M4. If yesterday's candle was green, today I'm going for M2, M4 day. Okay, this is what we have to happen in this scenario. So understand that since M3 and M4 in here are above the central pivot points, these are potential HODs and they are located above what? The central pivot points. M1 and M2 are possible lows of the day since they are located below the central pivot points. And like I said before, to get the possible trading range or your projection, you TP, just subtract the sister pivot points. Okay, so you just subtract M3 from M1 minus M3, you get your possible trading range. So pivot points are in ADR grid that is fixed. The extremes are representative of an ADR high or low. Since the grid is fixed, the trading ranges are not. Okay, so if we couple pivot points with the ADR mark, I think I've shown this indicator on day one where price will come in like this. Okay, let's say consolidation, information, price drops, makes a W. Okay, So if this happened to be M2, is it M2? Let me look back. Yeah, if this happens to be M3, yeah, M3 is above. Yeah, I was confusing myself. If this happens at an M3 pivot point, okay, this is now an M3 pivot point, we expect the low to be made at M1, okay, and now we can couple this, and we know that the pair moves what, 50 pips a day, okay. So if the dealer moves from this high to here to the low and he moves 52 pips, red lines like this will be drawn on the chart, showing that the dealer has exhausted his range. So if these two things line up, they will probably give you a good trading zone. And you can also add that probably maybe had a moving average going in here. And the last thing that we talked about was that blue tracer. We will also have a blue tracer in here. Okay, so you now have four things. You have a W, pivot points, a DR, moving average, and yesterday's low. Is a good strike zone for you to place your trade on the chart. Okay, this is what pivot points are used for. Okay, let's look at this chart. Okay, so on this day, red, is it cool? Price consolidated in here, went on, made an M formation at what, M3. If the M3 is the high, expect the low to be M1. Price will come back into the range. That's the trick, especially if you have 1, 2, 3 levels of drop, and within the third move there are other 3 moves, and within the last third move you have 1, 2, 3. Guys, it's all about 3. I won't stress that enough. There are people who believe in something when they see it 3 times. Here is the central pivot points. We are below the central pivot points, close to the M2. Here is the low. Repeat it again. Probably this was a type 2. You shift the zone to go to the M4, the sister pivot point, create the high at M4. You will pull back. You will not stay. You will not reverse at this high. Okay, so always understand that the big market moves, something like news, will often disrupt the pivot points for the following trading session. In order to find the opportunity, we must set some rules for trading when the price comes out of the wrong segment of the trading zone. What is that rule? Always identify the pattern, ignore the pivot points. It's just an indicator. The 60th thing on the list is not that important. So the last segment, I will move into the traders dynamic index, the TDI. Okay, so on the TDI, we have more components. I'll break down each one by one. Okay, the first component that we have is the RSI, the relative strength index, where it will oscillate between the 32 level and the 62. So you have to know that when the RSI is at the 32, you expect price to drop, and when it's on the 32, when the RSI is at the 68 level, you expect price to drop, and when it's around the 32, you expect price to buy. Okay, so trade long when the RSI goes outside to the extremes. This is the use of the RSI, okay, the relative. So adding another, we have a trade signal line, which is now the red line. So if I am selling, I want to see a crossover where the RSI goes below the red line, and if I'm buying, I want to see the RSI going above the red line. That would be a long. So for long, when the RSI price line goes above the trader signal line, trade short when the price RSI goes below the trader signal line. So in here we're going short, in here we're going long. You exit when they cross again, you exit when they cross again. So this was our end, this one is our exit, this is our end, this is our exit based on the TDI. Okay, so now adding the yellow line, the market baseline. As you can see, the market baseline is a moving 50, liquid 50. The market baseline is the overall trend. If it's below the 50, you expect a downtrend. If it's above the 50, it's an uptrend. It will differ sometimes. Okay, so trade long when they are, you will probably buy when the RSI price line is above the market baseline. You are looking for buys, and when it's below, you look for sales. Okay, this is how you connect the RSI and the market baseline. Okay, so as long as the market baseline, as long as the RSI is above the market baseline, you look for a buy, and if it's below, you look for a sell. The other thing is that the market baseline itself will help you pick some reversals. If it goes to these extremes, the 68 and the 32 levels, the market baseline, you are probably at the peak. So if you see that from here, this is level 1, this is level 2, I'm at level 3, and the market baseline is at level 68, there is a high chance that you need to sell. Okay, you go back to the 15 minutes, look for everything that we talked on day 1. Okay, the last piece of the puzzle is the volatility band. So we'll look for longs. We'll look for to sell when the RSI comes outside the band and comes back. So the same way, I would say the bands is the same as the 60 and the 32, but they will be moving. Okay, they will help you to identify also consolidation sometimes. So what do we use the TDI for is that we have to identify some shark fins, crossovers, blood in water. Blood in water is something like this, where the red line is inside the blue line. This is called blood in water. Red represent blood, the aqua color represent water, and also divergence. We have one leg inside the band, one leg outside the band. So the volatility bands acts as support and resistance based on the close. It's much stronger. They will based on the close of price. So when the band contains the RSI line after a break is divergent, which happen to be a stop band. Let me draw that for you. What I mean, we have this as our band. Okay, let me make it blue. We have this as our band, and we have our RSI trading. If RSI comes out in here, comes back, and fails to come outside of the band, that is called divergence. Okay, this one, especially if price is doing this, there is a difference. Price is rising while the relative strength index, which shows the closes of price, is decreasing. There is now divergence. These things, they are not moving in the same direction. One is rising while the other is falling. They are diverging. Okay, so divergence will help you to see the traps of the dealer. So when viewed in proper context, they can help you to identify stoppers and scale in and some exits. So what you will look for is a shark fin short. The bands will be tight. I already have drawn a shark fin for you, something like this. Okay, so a shark fin short would be something like RSI comes above the band, then comes back. Okay, so for a shark fin long is something like this. Okay, the bands are tight, the RSI breaks out and comes back. It's like a shark dorsal fin appears to be emerging from the water. So this is our water. The dorsal fin of the shark will be emerging from the water. On this one I don't know, but it's the opposite. Okay, so the fin goes back under the water line and crosses the signal line. Okay, this is what will be happening on the TDI. So for shark fin long, the same criteria is only that we are inverted. So let me show you what a shark fin will look like. So this is a shark fin. Okay, RSI breaks outside the bend, comes back. That's a shark fin. This is a shark fin. This is a smaller shark fin. Okay, these are our crossovers that we are looking for. Probably we have blood in the water, inside the red is inside the blue. Okay, we have one leg outside of the bend, one leg inside of the bend. That's divergence. As you can see let's put everything in context. From 0, Asian range 9 pips, vector move 1, 2, 3. You create a railroad track at the high of the day, and there is a shark fin outside of the bend. There's blood in the water. You get a crossover. You are a seller in here. This is how you use the TDI in context with the market. The same goes with this move. Okay, this is where we'll see divergence. Asian range in here 10 pips, false move 1, probably 2, the third might come in here. If you look, the first leg we have a shark fin, price breaks outside the volatility band. Okay, the second move, which completes the W in here, goes below the first leg in here. Okay, it's below, but the second leg of the RSI is what is above, and the RSI is already above the signal line. Okay, that is a signal for you to go long, especially if you have something like a railroad track in here. Okay, if you don't have, wait for the crossover, the 13 pullback, you enter in here, stop losses here. This is where I told you to wait for him to trigger what, the blue trace. I think you can see it now that I was not lying. Don't enter, the green number was cool though. Wait for him to do the strike zones. So this is another diverging example where we have 35 pip Asian range, false move 1, 2, 3. The third move is 1, 2, 3. Railroad tracks to the long. You can end on the shark fin, but the moment it closes below the 13, you exit. Okay, the second leg is formed. The second leg is lower than the first leg, but on the RSI we are having divergence because the second leg is higher than what, than the first leg. You enter a trade in here, boom, you made money. Okay, trading is simple, guys, as long as you are following the rules and putting everything in context. What do we have? 14 Asian range, stop and okay, look here, I told you if the tracer is around, is going to come for that numbers of yesterday. Okay, he came in here, triggered it the first time, the man was not enough, he came again aggressively. This was a green candle. It looks like a continuation for most of us. If we're trading this, it's a continuation setup. Okay, so the moment I close this, I would consider this to be an evening star. It's not quite a clear evening star, but if you consider these two candles, it will now be an evening star with what, a trap candle. This is a big wick. I end a short. What do we have on the TDI? Outside of the band, two shark fins. Okay, but if we look, the first leg is much higher than the second, but on price it's what, the opposite. We're having a lower leg, a higher leg. We are having a higher leg, a lower leg. The TDI is disagreeing with what price is doing. So this guy is saying, hey, no, I'm not falling for the false move. You want to trick me to buy, I'm not buying. The RSI is clever, guys. Okay, so the last part will be scaling with TDI. How can you add your position with the TDI? So the TDI offers few points to scale in with. Okay, so you end up at the low after the divergence. You add to your position as the RSI breaks the market baseline. Okay, the yellow line. You add again when the market baseline. You add again, sorry, when the RSI breaks the volatility band, and you exit all the units when price comes back inside the volatility band. Let me show you in here what I mean by this. Okay, so based on the TDI, my first position probably would have been here 1. Okay, when the RSI breaks below the what, this signal line, the yellow line here, I enter another position, I sell again. When it breaks this band in here or in here, I sell again. But if he comes in here, especially if I have the cross, I exit all my trades. This is what we have to happen. Okay, so first position at the high of the day, okay, the second at the break, the third at the break of the volatility band in here, then the last was exited in here after 3 levels of drop. You can see on the chart, you can see on the chart that we had 3 levels of drop. We probably had W into the New York session. So this is what we have to happen for you to add and scale in your trades. Okay, so this is what you have to remember for the whole course. You have to remember that anything fast in forex, it's false. That's why we have the false move, the vector 1 2 3, very aggressive in 3 candles. It's a false move. The other things is that never chase a rising or falling current. I had a friend of mine called Gide. What this guy used to do was that we did not know about the market makers method back then. When price was going all candles red, you could see that Euro USD is falling. You would start to sell Euro USD because it was falling. That's an amateur trading way. Don't do it. Okay, understand that the market maker drop price to buy, they sell price to buy. The market makers, they pump to dump. Okay, this is where you see an aggression in level 3 and then they'll trip. Okay, this is the pump to dump move. This move, pump and dump. They pumped price up and dump. The market maker will extend the high or low in 3 moves. Understood this from the Asian box consolidation stop and 1 2 3. The trend move is slow and steady, 6 to 8 hours. This one, I hope you know that it will vary. So market makers need to book profit also. So the trend move will contain 20 to 30 pips pullbacks and 3 levels move with the corresponding level of consolidation. A powerful extended move is always followed by consolidation to bring traders back into fray level 3. Okay, so we have come to the end of the course, guys. I like to thank you. These are my details. If you like to contact me on those numbers for those who have any problems. Okay, so on this day probably we do not have our homework, but what we have will be a roundup of what we need to do. Okay, so thank you guys for being with me over the course of these 4 days. I hope you have learned a lot. I hope you are going to put these things in practice. Watching the videos alone is not going to make you a good trader. Practicing on these things, marking your charts up, will make you a guru. Okay, thank you.